Hi, I'm Andrew Warburton, the Property Advisor, and in this video, I'm going to go over how to buy not one, but two homes, and how to go from zero to $250,000 over a 2-year period. This is not a gimmick, this is not a scam, this is facts, it's mathematics, it's how amortization works and how mortgage loans work, and I'm going to teach you how to take advantage of it. Just before we go into the details, I want to let you know at the bottom end of this video, there's a bit of math. But that math is going to show you exactly how that $250,000 happens, so please don't miss it. I value your comments as you go through, and I really get excited about helping people create wealth. So hang in there with me through this video, watch it, enjoy it, and let me give you the details of how you create wealth by buying not one, but two homes, and by going from zero to $250,000 in 5 years. Watch this. So you're about to buy your first home, you want to buy your first home. Let's make it very simple. Choice one, you buy a single family residence or a duplex. I like the idea of a duplex, particularly if you don't have a significant other. You buy a single family or a duplex with an FHA loan. FHA requires 3.5% down. Let's say that property's $400,000, 3.5%. It's not a whole lot of money. Okay, it's $14,000. You go, well, Andrew, I don't have $14,000. That's okay. You can do something called down payment assistance, where you have FHA as the base loan, and then you can get a state grant for the rest of the down payment. And they exist all over the United States of America. So you've acquired your first property. Remember I told you I would go over the math at the end. You go, Andrew, it can't be $250,000. Oh, yes, it can. And I'm going to show you how. Let's say you've now acquired your first home, or you've been in your first home for a while, and you're watching this video thinking, Andrew, I've heard about getting two homes. I just don't know how to do it. I don't know if I qualify. I don't know how to qualify. I don't know what kind of loan to get. Let me break it down for you. You can buy a second home, and this sounds redundant, as a second home. A lot of people say to me, Andrew, if I want to buy a second home, I've got to get an investment loan, put 20% down. It's not the case. There are some rules regarding a second home. Usually they have to be in a resort area. So let's say you live in the Inland Empire in California, and you buy a second home in Cathedral City, for example, which is considered a resort area. There are many, many examples, or by a lake, or by the desert, or whatever, or Havasu, or something like that. So you buy a second home in a resort area. Now, until very recently with COVID, you could do that with 5% down. You go, well, Andrew, I don't have the 5% down. I'm going to show you how. Right in the math at the bottom of this video. So the cheapest way is to do a second home. Right now, you need 10% down for your second home. But get a load of this. What if you've got a friend from college, a friend from church, a friend from high school, and you both sort of scratch some money together, and you're going to buy a $300,000 second home? 10% down is 30 grand. That's $15,000 a piece. So you set yourself a target right now that over the next year or 2 years, I'm going to accumulate $15,000. Or you can do many other things. As long as it's disclosed in your credit report and you can handle a debt to income ratio, you can go to your credit union and get some money to fix up your home. There are many, many ways of getting a short-term loan that you intend to pay off. And two of you go in together, because on a second home, you can both, as friends, buy a second home. Very low money down to acquire your second home. Or now you can do a full-on investor loan. There are two types of investor loan. One is called QM mortgage. Those are the best rates as a qualifying mortgage. It's all of Fannie Mae and Freddie Mac's guidelines. Now, until recently, again, you could do that with 10% down. Now investor loans are at 15% down. Same issue. On $40,000, that's $60,000. You can do three of you together. It's when you see this math, would you like a third of $250,000 or a third of nothing or all of nothing? It's the shift in mentality to say, I can acquire wealth, I can acquire $250,000 every 5 years, and I'll split that with two other people. So you can do an investor loan with one people, two people, three people. Now, on the second home, you qualify for that payment because it's your second home based on your own debt to income ratio. But on the investor loan, you qualify for that loan based on the rents you're going to get. And the lenders will allow you to use 75% of the rent that you're going to get to qualify, and any overage that there is, you only have to qualify for the overage. If there's 2 or 3 of you, it's not that tough. So you pay down one car below 10 months. The lender doesn't include it anymore. That car's $400 a month. Now you suddenly qualify for an investor loan. It's not that complicated. And fourth, you say you want to do it on your own. You have lots of cash flow. You're self-employed. And you don't show much on your tax returns. You can do now what's called a non-QM loan, a non-qualifying mortgage, which means that you qualify based on your bank statements rather than based on your tax returns. The interest rate's going to be a little bit higher. The loan might only be fixed for 5 years, but you get that opportunity now to amortize not 1, but 2 homes, thus creating wealth. How does that get you to $250,000? This gets a little tricky, so I want you to hang in there with me. You know through this series of videos that I've been talking about amortization. And amortization is from the French amor, I've told you this before, to death. The idea is to put to death that loan, which is you pay it down in an affordable way so that you can create equity. People are so hung up, is it the top of the market? Is it the bottom of the market? No. If you want to create wealth in real estate, get yourself accustomed to the idea of amortizing loans, because that is an inevitability. The market going up or down is not inevitable. Amortization is inevitable because it's mathematics. And that's how mathematics works. So I'm going to give you a scenario here that you buy your first property at $400,000. Okay? It's a $400,000 purchase, and this is year 0, and this is year 30. It's a $400,000 purchase, and after 5 years of making payments on that $400,000 loan, you now owe $358,000. Okay? This is after 5 years, $358,000. Now, also what's interesting, after 5 years, if you use a cost of living index of 3%, that property is no longer worth $400,000, it's worth $463,000. Now, whether or not it goes up, and the 3% per year is very conservative where you look over a period of time, but 358 from 463, that's 360, 460, 103, that's $105,000. It's your first $105,000. And you just made your payments. No extra amortization. If you added on $300 a month, by the way, this loan would be $338 and you'd have $125,000. So just adding that little bit on increases your amortization really, really fast. Now, here now, your home is no longer at $400,000. And let's do this in red. Your home is now $463,000. Now, you're at year 5, and you decide you're going to use one of these techniques right here, either buying a second home or getting an investor loan. And you say, Andrew, I don't have the money. Ah, but you do. So this time we're going to buy a $400,000 home. But we're going to go in here and we're going to get a HELOC on this property, a home equity line of credit, and we're going to take out $40,000. So now our equity here dropped to 65. We'll take out $40,000. You can do it because you've got plenty of equity in the property. You can take out that HELOC. You turn around here on your $400,000 property, you say, Andrew, you just told me that this was a 15% down, but let me tell you, very, very soon after COVID, you will see investor loans drop back down to 10% down. So $40,000, you buy a $400,000 home, you now take out a loan of $360,000. And let's say you go to 5 years. After 5 years, that $400,000 property, once again, is up to $463,000 right here. Your mortgage of $360,000 after 5 years is now paid down to $273,000. Here's the math. Your home's worth $463. You've paid it down to $273 because it was $360 originally. $273 from $463 is roughly, what is that? $190,000. And one more exciting thing, this home here, you've now paid it down because you're in year 10. And at year 10, the projected value of this home is $537,000. And you've paid down your $400,000 mortgage by this time to $309,000, plus the $40,000 you borrowed, $349,000. All right? That's $188,000. You have $188,000 in home 1. You have $190,000 in home 2. If you want to find out how to make money in real estate, watch The Property Advisor. Please click subscribe. Don't miss out on this. This is mathematics. I'm going to teach you how to create wealth. Thank you for watching.